Bond yields at new highs for the year and equities struggling to stage a comeback. Futures down about 0.7%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York, we begin with the big issue. Global central banks taking center stage.
We have the all-important Fed meeting.
The Bank of England.
The Bank of Japan.
The Fed has a lot of work ahead of itself, as do other central banks.
We've got this massive inflation.
The U.S. inflation number was horrific.
The hot core CPI print that we saw on Tuesday.
It puts the Fed into overdrive.
Credibility is based on that fact alone.
They are feeling their way to how far they have to raise.
The Fed isn't going to blink.
They're talking as if, they're Margaret Thatcher. This Fed is not for turning.
100 basis points is still on the table.
If they're in overdrive, sooner or later they're going to make a policy mistake.
I see inflation as the boogeyman and stagflation as the grim reaper here.
Joining us now to discuss is G Squared's Victoria Green and Morgan Stanley's Michael Kushmer. Victoria, you say the pivot is dead, long live the rate hikes. My question to you, there's two. How restrictive, for how long?
It's going to keep going up. I think pivot is going to go the way of transitory, and we're all going to be embarrassed, anybody who used it. So I think they're at least going to get to 4.5. They've got a ways to go. They talk about unusually large hikes last time coming out of Jackson Hole. So we'll see what they say this week. But the data certainly supports it. And investors have to remember the Fed does not care about the stock market. The stock market is not part of the Fed's mandate. The only reason the Fed may back off if there's turbulence in the market is if liquidity starts to lock up in the bond market. But I think we're ways off from that. So anybody looking for a bailout or a pivot, I think you have to kind of absorb the reality and realize that the Fed is going to keep going, and they really seem committed to keeping it through 2023.
And 4+ seems to be the consensus now, maybe even 5. Deutsche Bank went to close to 5 for next year on Fed funds. This is what Goldman had to say going into the weekend. They raised their Fed funds forecast by 75 basis points over the last 2 weeks and now expect the FOMC will hike by 75 in September, 50 in November and 50 in December to reach a terminal rate forecast of 4 to 4.25 by the end of 2022. Now, Michael Kushmer, there's two ways of looking at this. There's a group of individuals that write to me often and say, this economy can't stomach, take 4 to 5% Fed funds. Then there's another group who say that's not enough. Which camp are you in?
I'm in the camp that it's getting to be close to enough. I thought for a long time, 4% was a reasonable target. This is not the pre-COVID economy where 2.5% was enough. We had massive fiscal ease from 2020 through 2021. That has repercussions and flows through the system over long periods of time. And the Fed has to fight that as well as to an inflation rate, which looks anything but transitory. So I think, the 4.5% is certainly a reasonable target to have, but we have to keep in mind that monetary policy operates with lags, and we haven't had a 4% increase in interest rates, and I can't remember the last time the Fed raised rates 400 basis points in 1 year. So I think they will slow down once we get to 4%, but the jury is out as to whether or not inflation will fall fast enough in order to get the real Fed funds rate in the positive territory relative to core PCE or core CPI.
Well, Michael, can we sit on that? What is the appropriate time frame, do you think, that we need to get inflation back to target? And I understand that if obviously you need a period of below trend growth, but how much below trend growth do you need, potential growth here in America, to get that restrictive stance, to get inflation back towards target?
I think it's about how long you want to take to get to target. If the Fed is worried about the unemployment consequences and doesn't want to cause too much unemployment or too hard a recession, and they're willing to take their time, in other words, as long as inflation is on a steady downward trajectory, albeit a really hard thing to do to calibrate that, but if it's headed downwards and by the end of next year we're going to be sub 3%, then I think that the unemployment doesn't have to go up a whole lot, meaning, north of 5%, and somewhere in the 4% is probably enough. But if inflation stays stubborn, I think they'll just keep their pedal, to the metal, and they'll keep going. And that's when we hit 5%, because by early next year, it has to show signs of meaningful improvement.
Not seeing that right now. Futures down 0.7% on the S&P. Yields higher at the front end by 5 basis points, 392. We were higher than that a little bit earlier. The 10-year fades up only a basis point now, 346, after having a little look at life above 350. Victoria, just going through the numbers, comparing where we were back in June and where we are now. I've got nominal and real rates above the June highs. I've got an equity market still about 5% above the June lows. Do you consider it inevitable this equity market retests that June low?
Yes, I think there's too many factors that are going to drive it down. You're fighting seasonality. September's a weak month. You've got an aggressive Fed. You have kind of a weakening global macro viewpoint. So I do think we're going to retest the lows, if not go down to 3,400. I think this was a classic bear market rally, and typically when that happens, you come down and you push a little bit lower. So we are firmly in the bear camp right now. I think people that are looking at the unemployment is really the only thing that is signaling hope to people. And I look at it kind of, that silly meme of the dog drinking the coffee cup with the flames around him saying this is fine. The unemployment, the only thing that people think is this is fine. Everything else is burning down on fire, and you that's the only thing people look at. And I think you have to take data on the totality and what it's telling you: the inverted yield curve, the slowing PMI numbers, the inflation being sticky, not even oil and gas, it's core sticky now, which is the worst. And so you have to look at this and then add on the potential gas prices happening in Europe and in the northern states as we see what happens with Russia and the Nord Stream pipeline. And I think when you already have nations backstopping the utility bills and the amount of pressure people may see from rising gas prices, not on the gas meaning car gas, but natural gas, I think you just have too many factors that it's very hard. Eventually we'll overshoot, we'll hit oversold again, and we'll see a little rally off the bottom. But yes, I think we're going to retest a little bit lower back down to 3,400.
Can I just pick up on that meme just a little bit more? I think we're all familiar with that, Michael Kushner. Do you think this Fed is at risk of being emboldened by a lagging indicator, and that's the resilience they still see in this labour market?
I think that is a danger, that they go too far, because unemployment, labor markets takes time. It's a lagging indicator. Everything else gets worse before the labor market gets worse. But on the other hand, the optimists would say, look at all the job openings there are. The soft landing is about all the job openings go away without firing workers or laying off workers. That alone will loosen up the labor market and allow wages to settle in. If wages settle in back to a trajectory which looks like or is consistent with a 2.5% core PCE, then I think we're okay. But that is a bit of a heroic assumption. We're going to get that right now. So I do think that the danger is the Fed, because they lag so far behind, but also because the economy has proved to be much more resilient than anyone thought. There haven't been imbalances. If anything, household sector and corporate sectors are flush with cash, so they're not going to cave.
Mike McKee is going to be a man in the news conference a little bit later this week on Wednesday down in DC. Mike McKee joins us right now. Morning, Mike.
Morning, John. I think Victoria's description of the world has me scared to death, and I'm just going to go home, hide under the covers. This is a week for central banks around the world to raise rates. More than a dozen are going to be meeting this week. There are four big ones: the U.S. Federal Reserve, the Bank of England, the Riksbank in Sweden, and the Swiss National Bank, all of them expected to make big moves. The Bank of England, the only one at 50 basis points. Economists think the others will all go 75, and there is a school of thought that the Bank of England will go 75 as well. And this is going to dry up some liquidity around the world. It's going to be interesting to see what the impacts are on each country from all of this. You notice the Fed is the highest there. They'll get to 3.5% if we get to the kind of numbers that they are talking about. And that means that the Fed is going to be telling us not just where they are right now, but where they're going. And you can see here in the dot plot not only where the Fed thinks we should be, but where the market thinks the Fed should be, all the way over on the left-hand side. And then they will start going down in years to come. But where do those dots move? Do they move up to meet the market? Do they go higher than the market? And especially in 2023, that's going to be the big question. That'll be the first thing everybody wants to know on Wednesday. And then here's an interesting thought. Victoria brought this up earlier about liquidity. You can see how the Fed is doing QT. The blue line is the balance balance sheet going down, Treasury holdings. The white line is also going down. That's Treasury issuance, which leaves a big hole there to fill. And as you can see, as the Fed raised rates, liquidity gets a little bit worse. Now, it's compared to rather than on a full basis of what liquidity actually is. But you can see that oval there, John. That was 2018. And you can see the small bump in liquidity tightness that led the Fed to stop raising rates. So look at where we are now. And let's wonder what's going to happen when the Fed goes even higher.
Mike McKee. Thank you, sir, as always. I have to say, I'll admit to you all, I've struggled to find a bullish note. I've been looking. Wells Fargo and Chris Harvey came close enough. This was the line that they used. The anticipated decelerating path to terminal by the market and ourselves is, in our view, expected to be a near-term positive for risk assets, including stocks. Victoria, I wanted to come to you on that, and I'm going to read it again. The anticipated decelerating path to terminal by the market is, in our view, will be a near-term positive for risk assets, including stocks. What's the pushback against that?
I think you're really reaching to find some positives there. It's like if you lost a football game, but your cheerleaders did really well, it's still not a good thing. Like, I think even if we slow down, they're still raising rates. And Powell has made it very, very clear they do not want to do the start, stop, raise lower. He really seems to want to be committed to raising rates and keeping it there and having a sustainable path. So I think that you need to look at expectations and reality. And reality is Powell is extremely hawkish. They have worked very hard this month to bring back the pivot talk and make sure everybody understands their path forward. So I think a deceleration of rate hikes are still rate hikes, and I don't really see them cutting. I know he really wants to keep them elevated for longer, and so I think that's possibly reaching for a little, like, if you torture data long enough, it'll say anything, and I think that's a little bit reaching for something bullish to see. And eventually, yes, it'll get bad enough it's good, but I don't think we're there yet.
Next time Chris is on, I'm going to replay that clip, if that's okay, Victoria. Victoria Green and Michael Kushner sticking with us. We're down 0.75% on the S&P 500 with your movers going into the open. Here's Abby.
Hey, John. Well, we do, of course, have stocks down, as you were just mentioning, and a big piece of it, tech is weak. And this, of course, has to do with the fact that yields are rising, making these stocks look more expensive from a valuation perspective. Relative to Apple, though, at least one analyst, KeyBank, that bank, they are saying that the demand for the new iPhone, the launch, it's a little bit mixed. The high end is good, but the rest of the group a bit tepid. So shares of Apple down at about 0.75%. NVIDIA down 1.1%. Its annual launch event, or its annual event, is today. Of course, though, this company recently pre-announced. They then missed those pre-announced numbers. The stock is down more than 50% year to date. So they have a lot to explain. Plus, today, yields higher, as I was mentioning, pressing on that big chip maker as well. Yields up, not helping banks, though. Bank of America down 1.3%. This probably has something to do with the inverted yield curve becoming a little bit more inverted on the day. That short end higher than the long end. That 10-year yield, as you mentioned briefly, above 350, but backing away. And then finally, a bright spot. Who knew? Netflix up 2.7%. Oppenheimer has upgraded to outperform on the ad tier plan, that cheaper $7.99 plan, saying that it should accelerate sub-growth. True, John, but of course it's also a race for content. It's going to be interesting to see how things work out for Netflix. That stock down still 67% from its peak.
Abby, thank you. Looking forward to catching up with Dan Ives of Wedbush a little bit later this hour around the opening bell to talk about some of those tech names. Coming up on this program, President Biden striking an optimistic tone.
We're going to get control of inflation. We're in a position where for the last several months it hasn't spiked, and in the meantime we created all these jobs, and prices have gone up, but they've come down for energy.
AMH is in New York City. That conversation up next.
I'm telling the American people that we're going to get control of inflation. We're in a position where for the last several months it hasn't spiked, and in the meantime we created all these jobs, and prices have gone up, but they've come down for energy. We still have a problem with COVID. We're still doing a lot of work on it. But the pandemic is over. I'm more optimistic than I've been in a long time.
President Biden appealing to voters ahead of the midterm elections, addressing concerns both at home and abroad.
We agree with what we signed on to a long time ago. and that there's a one China policy, and Taiwan makes their own judgments about their independence. We are not moving, we're not encouraging their being independent. We're not, that's their decision.
But would U.S. forces defend the island?
Yes, if in fact there was an unprecedented attack.
Team coverage starts right now with Josh Wingrove down in D.C. and Anne-Marie here in New York City. Josh, we've got to go straight to those comments. Not the first time. And did we get the White House walk back to go with it?
Yeah, it's a part and parcel package that we're used to now, John. This is, of course, going back to May. He said something similar, that U.S. forces would defend Taiwan if necessary. They sort of tried to put the cat back in the bag on that and said, look, you know, the U.S. one China policy hasn't changed. You know, that is sometimes referred to as strategic ambiguity. He's injecting a little more ambiguity into it these days. He's gone back to the well with this interview again, saying that if there was that, quote, unprecedented attack, didn't specify what that means, that U.S. forces would defend the island, and spoke to people very quickly saying, look, the one China policy hasn't changed. He's said this before. So we're at the point now where his, him getting 1 foot too far out in front has precedent. They can just point to that to wave it away. But that is really one big takeaway from that interview last night with 60 Minutes.
MH, that's the international concern. The domestic one, the midterms, just around the corner.
Yeah, certainly. But you heard what the president said at the end of that interview. He said that he's optimistic at this moment. They're off the heels of a number of legislative wins, whether it's the CHIP Act, the Inflation Reduction Act. And just last week, Josh and I were standing next to each other in the Rose Garden. The president was coming out and talking about the fact that the White House was able to intervene and make sure that there was not a rail strike. And Josh and I were talking to the union leaders and the rail leaders. They gave this very tongue-in-cheek hug. And it does look like that vote potentially will go through. And this is something the president was able to avoid, which really would have wreaked havoc across the economy. So if they're able to maintain right now this path they're on, the Democrats, what you see in the polls, are doing much better. This NBC poll, pretty astonishing. You look at the fact the president's approval rating is now at 45%.
Sure.
We have not seen this in 1 year since October of 2021.
You wonder how many unions will follow with the same request now, Anne-Marie, based on what happened in the last week.
Yeah, well, you make the point of basically labor demands are changing.
Yeah, isn't that the script now for pretty much everyone?
Yes, and it's not just what you're seeing in union workers, right? This is a broad spectrum of employment. It's a very, very tight labor market, and especially following COVID-19, when you saw that you need health care, you need parental leave, you see workers coming back and asking for more. And if you look back historically on strikes, when you had Truman and you had the steel strike, it was about workers' wages. When you had President Roosevelt and you had coal, it was about shorter days and worker wages. Now with Biden, it wasn't about we want higher wages. It was about we want to make sure we can take medical leave and we can take sick leave and make sure we still have our jobs here.
MH, thank you. Anne-Marie here in New York City through the week. Josh, thank you, buddy. As always, over in D.C. Want to fold in the Fed as we always do. This from Julian Emanuel of Evercore. He wrote this. So as the Fed hiked 75 basis points on September 21, with the market pricing near 75 for November 2nd, 6 days before an election, where there is a non-zero probability we won't know which party controls the Senate, House or both, and a near 100% probability that the aftermath will be bitter and contested, the Fed, he says, should moderate its 1970s fixation. Michael, can I come to you on that? Do you think this Fed has to consider the midterms, which are about a week later after the November decision?
I don't think it'll be a primary factor in their decision making. If inflation data between now and then remains poor, in the sense that it stays high with no signs of deceleration, I think it's too early to quote unquote pivot and feel like they're caving into some kind of political pressure or worries about the future. Inflation, I think, is individuals or citizens' number one worry, and that by addressing that measure, addressing inflation, the Fed is doing its job and will not be viewed too negatively across the political spectrum.
Until unemployment starts climbing. And Victoria, that's going to be the big change for this Fed. And I would argue with the discourse down in Washington, D.C., everyone's on the same page. It's the same script. We want the Fed to have the space to do what it's got to do until, of course, unemployment starts to climb and things go south. So I'd ask you this, Victoria. Do you expect the Federal Reserve forecasts at this Wednesday meeting to capture the risk of a so-called hard landing, to capture unemployment rates that have to go higher, growth rates that have to go lower?
I mean, they have showed their willingness to sacrifice unemployment. They talk about their singular fixation on inflation and that they are aware what this may do to the labor market, and they see the labor market as strong. So I think they've already thrown out the labor market as the sacrificial lamb, and I don't think that's necessarily going to change. I do hope the Fed stays its course. It's supposed to be apolitical. They need to be doing what's right in the long term and not thinking in 6 months, 12 months. They need to get the country back on track. They need to get inflation as much under control, and they have to be scared by that sticky print we saw in August with the food prices, healthcare prices, and shelter still being a massive problem, and those are harder to fix. So yeah, it's easy to say that. I'm not on the Fed board, but I think that they're going to really struggle to get this soft landing. I think they are trying to do their best to communicate. I look at what they did here in September, which I think they had to rip this Band-Aid off and quell all the talk of a pivot. So I think they're doing a good job of communicating. I'm not sure anybody could land this into a soft landing, regardless of who's at the helm. So they may be doing a bit of a thankless job right now.
I think someone earlier said it was like landing a jumbo jet on a picnic blanket. That's how hard it is right now. Michael Kushner, Victoria Green, to the both of you, thank you. Right now, a 2-year yield higher by 7 basis points, 394 on a 2-year. On a 10-year, higher by 3 basis points. Just short of 350, went through that level earlier. At the moment, at about 348. Coming up, the morning calls and later. Tech stocks, extended declines after the worst week since January. More on that at the opening bell with Dan Ives of Wedbush. Live from New York, this is Bloomberg. 5 minutes away from the opening bell, equities heading south, down 0.9% on the S&P 500. Yields heading north. Your 2-year, 394. Your 10-year, very briefly, through 350. Yields up again by 3 basis points on 10s on 2s, up by 7. Levels we haven't seen since 2007. As the price action, here are your morning calls. First up, KeyBank upgrading the home builders to overweight from underweight, seeing better upside after the sector's recent sell-off. Next up, Wells Fargo downgrading Adobe to equal weight, saying the company's recent $20 billion acquisition leaves little room for error. And finally, Oppenheimer upgrading Netflix to outperform, expecting the company's new advertising tier to accelerate subscriber growth. That stock up by a little more than 2%. Coming up, tech stocks extending their declines after recording their worst week since January. Wedbush's Dan Ives expecting America's biggest tech giants to overcome a challenging backdrop. That conversation up next, your opening bell, just around the corner. Live from New York, 20 seconds away from the opening bell this morning. Good morning. Coming off the back of the biggest weekly loss on the S&P 500 since June. On the Nasdaq, even further back than that. Futures down 0.9% on the S&P. On the Nasdaq, we're down about 1 full percentage point. On the Russell, the small caps, we're negative a little more than 1 full percentage point. That's the opening bell. Switch up the board and get to the bottom market. Yields higher, much higher. On a 10-year by 5 basis points, 349.63. Remember, everyone said the highs of the year would be in June. Well, we took out the June high a little bit early this morning, through 350 on a 2-year that's been climbing for 8 consecutive sessions, up 9 basis points, and now looking at 396 on a 2-year yield in America. Without doubt, you can imagine the dollar is a whole lot stronger. It is right now. Euro dollar negative 0.4%, 99.77 on euro dollar, and crude heading south. We're down 3.29% on WTI at $82 and about 30 cents. 30 seconds into this one, around the opening bell with your movers. Here's Abby.
Hey, John. Well, it really does have everything to do with those rising yields and that stronger dollar pressing stocks down. That's especially true for big tech. Microsoft down more than 1% at this point, down 1.1%. Something to keep in mind. Last week, we, of course, had a number of companies, big conglomerates, pre-announcing to the downside. Microsoft was one of the first to do that on the foreign exchange effect. Let's see if there's more to come there. ExxonMobil down 2% as oil, as you were just showing, falling even more. That stronger dollar pressing risk assets overall. JP Morgan, though, banks not getting a bid from rising yields. This as the yield curves invert a little bit more, the short end going up more than the 10-year yield, or the longer end, I should say. And then finally, I will dare to mention crypto and Coinbase and Bitcoin. Bitcoin technically very weak, on the brink of a bigger breakdown that it's already done. That is, of course, weighing on everything related to crypto and Bitcoin. Coinbase down more than 4% on the session, John.
Tough session for everything and everyone right now, Abby. Thank you. Stocks down, bonds down, yields up. When will that positive correlation between those two things break? Right now, toxic for pretty much everyone invested in the market. Yields higher, equities lower by 0.8% on the S&P 500. Energy, where the underperformance is, we're down 2 percentage points. Information technology down about 0.8%, extending the declines on tech stocks after the Nasdaq just posted the worst week in 8 months. Here in New York, for more, here's Ed Ludlow. Hey, Ed.
Good morning, John. We're down 0.7% on the Nasdaq 100, off that worst week since January, in a week where the Nasdaq 100 shed almost $900 billion of market cap. What's interesting is this is not just the most speculative corners of the market. The mega caps, the growth or quality stocks also caught up in this. If you look at the losses of the last 5 sessions, half of it came from just 6 single names, the creme de la creme of mega cap technology shares. We have the prospect of the 75 basis points hike by the Fed this Wednesday. Higher rates discounting the present value of future profits. But then there's the narrative around 100 basis points, right? The outlook for global growth. Could a slowdown in the global economy also erode the profits of these tech companies who so far have fared well? We've got about 77 stocks down on the Nasdaq 100. One pocket of green is Netflix. You talked about that upgrade from Oppenheimer, the latest street name to talk about an ad-supported tier. But elsewhere, we're seeing declines in most names, apart from Nvidia. Interesting one, up 0.3%. Really interesting, the ARK Innovation ETF loading up almost 400,000 shares of Nvidia this month alone, John.
Ed, thank you, buddy. Good to see you here in New York. Ed Ludlow there, breaking down the tech moves. Alluding to the bond market move as well. What a move we're seeing at the front end of this yield curve, up 8 basis points, 395 on a 2-year. 3,360, clean break of 70, 80, 90, and now talking about 4%, 5 basis points away on a 2-year. The 10-year flying as well this morning. Kaylee Lyons has more. Hey, Kaylee.
Hey, John. Yeah, it's been absolutely wild. 3.5% on the 10-year realistically is what we're looking at on the nominal yield. When you adjust for inflation and take a look at that 10-year real yield, it's now sitting at 1.13%. That is the highest going back to 2018, and that is very problematic for equities and specifically tech stocks. Over the last month, the Nasdaq 100 down about 11%. It's down 27% year to date, and of course, borrowing costs being higher has everything to do with that. What's interesting, as we've seen prices come down so substantially for tech stocks, that's even as earnings estimates are essentially hanging in there. So all of that multiple contraction, forward multiple contraction, has been on the price side. Where that PE multiple stands now going forward, about 22 times forward earnings. So yes, that is down from where it was just a couple of months ago, but still that remains elevated relative to history. So these stocks are still expensive. And obviously we're talking about public companies, already public companies here. But on another note, this is hitting the primary market too. Not a lot of tech companies think they will find a warm welcome in the public markets right now. About $667 million worth of tech and communication IPOs have been announced this year. Almost all of that was back in January. And actually, year to date, across 8 months combined, there have been fewer tech offerings than in any individual month last year, John.
Those numbers are absolutely incredible, or the lack thereof. Just the zeros at the bottom of that chart. Kaylee, thank you so much. Yields up, tech down. It's an easy to understand story. Dan Ives of Wedbush has this to say. The Fed backdrop clearly is making this a brutal market for picking tech stocks, but we're not throwing in the towel on our long-term bullish thesis for the sector. Dan Ives, I'm pleased to say, joins us now. So, Dan, you took us there. Let's begin there. You've got a 220 price target on Apple. We've just had a 100 basis point move in real rates since the beginning of August. How do you get to 220 on Apple if that's the rate backdrop?
Yeah, look, I mean, and clearly it's a brutal backdrop for tech stocks, but for Apple, it's a good example. I mean, I look at iPhone 14, it's tracking what I believe is mid to high single digits above iPhone 13. I think the growth and the underlying numbers, Street is still underestimating. So I think Apple's a name. You're going to see this digestion period, and obviously in terms of the Fed backdrop, but in terms of growth and in terms of what's happening on services, that is still underestimated in terms of what we see. And that's why I believe Apple here, risk reward makes it just a compelling, I view as a table pounder name if you have a horizon 6-12 months out.
Dan, let's just sit on that. Just the shift to the higher ASPs as well in Apple units. Is it just about the volume or the average selling price as well that's giving you a little bit more confidence?
Yeah, I mean, we think it's about 80, based on our estimate, 80 and 90% are Pro Max. That goes to 60, 65% in the year ago. So that's significant for ASPs, for revenue, for Apple. I think a lot of that is China-driven. We're seeing many more go toward the Pro and Pro Max. And overall, despite this dark storm cloud in terms of the economy, brisk sales, in the U.S., even what we've seen over the last week.
Dan, are you confident they can meet that demand on the supply side?
Well, I think they have done almost superhero-like ability, what Cook and Cupertino have done in Asia to get ready for iPhone. We think 90 million units was the initial order, and that's already, in stone. I think they could be potentially upping those units in terms of what they're going for. Supply, I think the worst is in the rearview mirror, and that continues to be, our thought in terms of tech. One of the biggest risks was the supply chain, and we're starting to see it significantly moderate. And that's why it's bullish for Apple and it's bullish for names like Tesla that we see in China.
Dan, where does the consumer fit in here stateside, when many people are forecasting a much, much weaker one over the next 12 to 18 months? How does that fit into the bullish thesis around what is essentially a high-end consumer-priced piece of hardware?
Yeah, look, I think it's easy to just paint it with the same brush, say economy, consumers are not going to upgrade. John, I look at our numbers. I think there's about 240 million of 1 billion iPhones that have not been upgraded in 3.5 years. The pent-up demand is massive, which is why this continues to be able to power through any sort of economic downturn that we're seeing. I believe that's what we're seeing play out. And I think when you look at Apple, it's one, even on the services business, that's when it's going to see an uptick. And that's why I just continue to view Rock of Gibraltar names, Apple, Microsoft, some of the cybersecurity names like Palo Alto and Zscaler. It's clearly easy to yell fire in a crowded theater here on tech, but our best calls have been in these environments in 2000, 2001, 08, 09, and early 2020, and that's why we continue to stick to our knitting in terms of tech.
Do you need lower yields for this to work, though, Dan? Do you need a repricing of yield to lower for these calls to work?
Look, clearly the fight in the Fed, continues to see a risk off and multiple compression. But I do believe a lot of that's starting to get priced into these names. And I believe it's the most negative we've seen tech investors going back probably 2009, 2010 in terms of these names. So I'm just saying a lot of bad news, not just Fed and macro baked in relative to what we're seeing growth. And also the enterprise names are holding up well. Microsoft, Oracle, among others.
There was one name you didn't mention in all of that. You named most of the big tech names, the likes of Apple at the front of it all. Dan, you didn't mention Facebook. How do you think these social media names are going to hold up in the face of slowing growth, not just domestically but worldwide, and tighter Fed policy?
Yeah, well, I think there's a bullseye on social media names, specifically names like Meta. I think they're going to have hurricane-like headwinds, not just because what we're seeing in terms of slowing macro, but also digital advertising dollars and what's happened with Apple iOS privacy issues. And I believe social media, that's why you have Facebook going to the metaverse and some other areas. And I think numbers could continue to be under pressure over the coming quarters. That's why in tech, it's a bifurcated tech landscape. We stay away from social media names. We continue to focus on enterprise and our core consumer names.
Dan, got to fit this in. You're a bullish guy. Some people would say certain names are permeable. Apple might be that name, and I'm sure you'd appreciate that. Can you tell me the number one risk to your bullish thesis at the moment for that name?
Yeah, the number one risk is China. I mean, that can, from a supply perspective, that is the number one risk in terms of Apple, despite everything that we've heard. And at least so far, what we're seeing, going back even to the last month, I feel a lot of that pain and bad news from a supply chain perspective are in the rearview mirror.
Dan, good to catch up, buddy, as always. Dan Ives of Wedbush, bullish on the likes of Apple, much, much less so on the likes of Meta. Coming up, global equities remaining under pressure following their worst week since June.
And we have even more conviction in the need to be defensive at the moment. So I understand a bit the fact that risk assets today and in the coming days may remain under pressure.
With equities down about 0.5%, that conversation up next.
we have even more conviction in the need to be defensive at the moment. So I understand a bit the fact that risk assets today and in the coming days may remain under pressure. This said, within this difficult environment, the fact that we may not be far from the peak interest rate in the US is reassuring for the outlook. So there are a lot of uncertainties, but we see opportunities in the market at the moment that we didn't have a couple of months ago.
Stocks down, inching lower by a third of 1% on the S&P after a brutal week last week. The S&P 500 posting its steepest weekly decline, going back to the ugly lows of June. Taylor Riggs has more. Hey, Taylor.
John, and like you've been mentioning really all hour, tech is sort of the big underperformer of that. But like you said, really important to focus on sort of that broader market. So we'll hone in here on the S&P 500 as well. September has been traditionally a little bit of a tough month. And this month and this year is certainly shaping up to be no better. Still some of the worst months on the year, off about 3% or so. The average going back to 1996 for September is traditionally an 0.8% decline. So you're really seeing this year with that rate story, a lot of that underperformance and a lot of that volatility to really come out. You mentioned, though, technology. Take a look at this. The S&P 500 is down about $8 trillion year to date. $3.2 trillion of that is coming from the top 7 sort of big tech companies. And you see that. And I hate to be a broken record, but this does still feel like yields are rising, a rate of change that is really starting to put pressure on these long duration assets.
Equities trying to break away from the lows of this morning. Yields are still just off the highs of this morning. Taylor, thank you. Equities down about 0.25% on the S&P. The Nasdaq down by just 0.2%. But yields are still near the highs of the session at 295 on a 2-year, up 8 basis points on a day. On a 10-year, up 4 or 5 basis points, just short of 350. I said it earlier this hour. It's very, very difficult to find any constructive view on Wall Street at the moment. Maybe Marko Kolanovic and JP Morgan one. Chris Harvey of Wells Fargo, another. This is Goldman and Morgan Stanley. This is what they've got to say. Goldman's David Kostin seeing the headwinds for profitability starting to pile up. Morgan Stanley's Mike Wilson echoing his views, citing concerns over tighter financial conditions and pressure on margins as well. Kaylee Lyons back with us for more. Hey, Kaylee.
Hey, John, a little bit of a broken record in that you can count on these two to be bearish more often than not. But what they're pointing out here really is you still have an inflation problem, a big one in the U.S. Not only does that put pressure on corporations on the margin side, but also to get inflation down, you have a Federal Reserve that is hiking interest rates aggressively, probably will again on Wednesday. And those higher interest rates put pressure on corporates, too. So that is why you see the S&P 500 down roughly 19% on a year-to-date basis. But there's something going on in this chart that doesn't necessarily match up. As you've seen those dramatic declines in equities, earnings estimates pretty much holding in there. They are still right around record highs. And actually, if you look at analyst estimates for both 2022 and 2023, they still imply that rolling 12-month earnings will maintain an upward steady slope. So even in the face of growing recession risk, that is still holding in there. And Mike Wilson has pointed out in his note that revisions are often glacial in pace and that there is still a long way to go before reality is fairly priced. In his base case, the S&P bottoms near 3,400, though he said in the bear case recession scenario, it would be more like 3,000. Those on Wall Street, though, aren't quite as pessimistic. The average year-end target currently is at 43.46. The average EPS estimate at 2.24, though that is down significantly since the start of the year. You can see there that average forecast has been trending steadily lower for months now. We're down about 500 points below what it was back in April. But if those earnings estimates start to more materially roll over, John, it's likely that those index level estimates are going to fall further too.
Kelly Lyons, thank you. Mike's been talking about this for a while. Mike Wilson has absolutely nailed it so far in 2022. Rate shock first, we've had that. Have we seen that fully materialise? Now he's looking for the earnings shock as well. Mike Wilson this morning, Kelly talked about some of those numbers. Let me repeat a few. We believe the S&P 500 will bottom near 3,400 in our base case. Went on to say 3,000 in our bear case recession scenario before rebounding in the first half of next year as visibility around a growth reacceleration forms. Just a rare hope there in a paragraph from Mike Wilson. Right now, 38.59 on the S&P. That's the equity story. About 20 minutes into the session. Let's get you some sector price action. Here's Abby.
Hey, John, well, let's take a look at what is happening for the S&P 500 sectors, because we are off of the lows, and that means not all S&P 500 sectors are lower at this point. Now, interesting, because we've been focusing so much on the tech weakness, we actually have healthcare as the worst sector on the day. Right above it, real estate. These are yield-sensitive sectors. So for the first time in a long time, to my memory, we can actually see that these yield-sensitive sectors are acting as they should. They're down when yields are higher because their dividends look less attractive. Tech down, though, also about 0.5%. But you can see the bulk of the sectors at this point are up modestly. It's going to be interesting, of course, to see how this day finishes. Over the last week, or I should say last week, tech absolutely brutal. The sell-off at one point, the S&P 500 tech index over the last week had been down 7.5%. That was at that point the worst week, going all the way back to March of 2020. You can also see that the SOX, the New York Stock FANG index, with a lot of those China tech stocks, and in fact that Golden Dragon China index down 8%. So tech in a rough spot as yields just continue to back up. Let's see whether or not that dynamic continues. Today, a little bit of amelioration of that situation.
It's trying to stage a recovery off the ugly lows of early this morning. Abby, thank you. We're down 1/3 of 1% on the S&P, down about 1/3 of 1% on the NASDAQ as well. Coming up, we'll bring you the trading diary and we'll touch base with our good friend Guy Johnson over in London. We'll do that next. From New York, this is Bloomberg. Historic time in the United Kingdom. Queen Elizabeth II's coffin arriving for the long walk procession to St George's Chapel in Windsor Castle. Guy Johnson joins us now from London. Guy, describe the next couple of hours for us.
So what is happening right now, John, is the royal hearse, which has made its way from central London, Hyde Park Corner. It is now making its way through West London. It's left West London. It is now approaching Windsor. And it's making its way for Windsor Castle. It's ultimately making its way to St George's Chapel, where the committal service will start at 4 p.m, John. After that, the Queen will be buried in the King George VI Memorial Chapel, and her husband's body, Prince Philip, who died last year, will ultimately be moved to rest beside her as well. So that's going to happen over the next few hours. What we've just seen today is obviously the state funeral. That was for the world. This is more for family. This is more for friends. This is the royal family coming together to pay its respects to the Queen and to say goodbye, John.
And Guy, the official period of mourning in the country closes. I just wonder what that means for Prime Minister Liz Truss, Guy. Is it back to business as usual? Because business is not normal in the UK.
I heard Lisa joking about this a little bit earlier on, John. Business as normal, confronting reality. I think all of this is going to be the narrative for the next few days. The Prime Minister has an incredibly busy few days. Her government has an incredibly busy few days. She's going to go to New York. She's going to go to the UN. She's going to have a bilateral with the President of the United States. We think that's going to happen on Wednesday. Before that happens, though, we understand that we're going to get details of the energy plan. That's going to come out on Tuesday and Wednesday. We've also, of course, got the Bank of England coming up as well. And we've got this mini fiscal event taking place on Friday. We are waiting to find out exactly what the details are going to be announced in that. So a period of mourning comes to an end. And this is a country that does need to confront the reality of a very difficult economic situation, a very difficult winter upcoming for the United Kingdom.
Guy, what do you make of the sequence of that? And do you think that Governor Bailey would prefer to be on Friday and the mini budget on Thursday?
I think he would have a better idea of what is obviously going to be the final detail contained within that budget. I would hope, I would imagine that there is maybe some lines of communication between the Treasury and the Bank of England so that they do have an idea of what is ultimately coming towards them. In the past, fiscal and monetary authorities have worked very closely together. It's going to be interesting to see whether that does take place again between this Chancellor and this governor, but I would hope at least they would have a clear understanding of what that fiscal event is going to look like. I think it's the Fed that they'll be watching over their shoulder carefully for. I think that will make the decision-making process at the Bank of England even more tricky, I think, John.
Sure.
Maybe it's not the fiscal event. It's the Fed that really is going to muddy the waters there for
With
them.
sterling looking at 113 again today. Guy, looking forward to the coverage alongside Alex Steele. Guy Johnson, our good friend, is going to catch up with the whole situation in the UK over the next couple of days. He's going to kick things off in about 5 minutes' time. Going to kick things off with you with the trading diary and the rest of the week's look ahead now. US housing starts on Tuesday. Busy Wednesday, kicking off with existing home sales. Then President Biden delivering a speech at the UN General Assembly. The big bank CEOs speaking on Capitol Hill. The main event, a Fed rate decision followed by Chairman Powell's news conference. Central bank decisions from the BOJ and the BOE coming on Thursday. The Bank of England is in such a tough spot right now, as is the BOJ. J. Then we get another round of initial jobless claims as well on Thursday, and US PMIs to close out the week on Friday. With your equity market staging somewhat of a recovery at the moment, we're down about 0.2% on the S&P. On the Nasdaq, almost flat on the session. Given what's happening in the bond market, that's somewhat surprising. Yields up 8 or 9 basis points on a 2-year at 3.95. From New York City, good to be back with you. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.